While rising interest rates are generally good for banks, banks will likely see only a moderate benefit from any rate hike from the Fed. That's just one of the findings in a new report by Moody's on the outlook for the banking sector next year. I'm joined by Moody's Vice President, Joe Pucella. Nice to see you here.
Nice to be here. Thank you.
Let's start with positives first. You've got a stable outlook for banks for this year, and actually maybe 18 months, so even beyond 2016. What's working in favor for the banks in your view?
So the stable outlook on the U.S. banking sector is really driven by the strength of their balance sheets, and that really shows itself in three main ways. One, strong liquidity, so the banks are core funded. Two, thanks to the regulators, capital ratios have improved. And finally, strong asset quality metrics today, which you see in very low credit costs.
All positives, but you are a little concerned about what potentially could happen on the revenue side of things with growth. What's the worry in your view?
Well, we're concerned about the impact of short-term interest rates on the banks, and specifically the revenue pressure that creates. And so in this low-rate environment, with the revenue pressure, that really encourages banks to loosen underwriting in order to grow loans to offset that revenue pressure. And
although wasn't that supposed to be something that we worry about less after the last financial crisis?
Well, we're now well into the recovery, and so we're starting to see some weakening signs on some corporate loan indicators.
Gotcha.
And so this weakening is happening at a time when we're getting to the late stages of the credit cycle.
And in terms of commercial lending, how much of a worry? I mean, are we just kind of seeing the edges fraying a little bit, or could there perhaps be telling us there's more problems ahead?
Well, you're not really seeing deterioration in the asset quality metrics today. That'll happen as the economy weakens, but you're starting to see loosening underwriting standards. And specifically, we're worried about some of the key leading indicators. So, for example, core business sales, corporate profits, all showing negative trends, utilization rates as well, and those are all negative signs for commercial credit.
You also think, from the bank's perspective, they might have to now do a little bit more cost cutting. Even though there's been a lot, there might be more to come. Yeah,
so banks have been cutting costs since the financial crisis.
Yeah.
But given the protracted period of low interest rates, banks need to continue to do that to try to improve their revenues.
And Joe, is there anyone in the group that stands out as perhaps being a little stronger than others on the U.S. side?
Well, I think if you look at just returns, a couple names stand out, like a U.S. Bancorp and a Wells Fargo, which are reporting returns in excess of their cost of capital. And I think one of the primary reasons, beyond just reporting low credit costs, like most banks are today, they're very efficient operators. And so all banks are trying to get more efficient, but the efficiency is really a hallmark of these companies, and so they've been able to benefit from that.
What would you need to see to change the outlook from stable to negative?
I think a recessionary environment obviously would be bad for not only commercial credit, but for consumer credit, which today is pretty strong. So a weakening in consumer credit, which then feeds into a weakening in asset quality, would be one key driver for a negative outlook. Or if we saw overly aggressive underwriting continue.
Does it matter, in your view, whether the Fed raises by 25 basis points, 50 basis points, or does a series of rate hikes next year? Is there a way to quantify that and the outlook?
Well, we expect a gradual and moderate increase in rates over the next 1 to 2 years. But just given where we are in the credit cycle and some of those weakening signs that I mentioned, we don't expect significant or meaningful increases in rates. And so, any rise in rates is beneficial for the banks, but we just don't think it'll be enough for them to really get over some of the other headwinds.
Joe Pucella, great to talk to you. Thank you so much.
Thank you.
I'm Rhonda Schaffler for The Street.